Bitcoin price dip shakes trader confidence. Is the 2025 bull run in danger? The recent dip in Bitcoin's price has sent ripples through the trading community, raising questions about whether the much-anticipated 2025 bull run is now at risk. But here's where it gets controversial. Despite the sharp decline, the overall market signals suggest caution rather than an outright collapse. So, is this just a temporary wobble? Or are we witnessing the beginning of a more significant downturn? Key insights reveal that Bitcoin options markets are hinting at a cautious stance rather than outright bearishness. While some indicators, like Bitcoin ETF outflows and futures premiums, lean toward a neutral to bearish sentiment, they stop short of signaling panic among investors. On Friday, Bitcoin's price dropped to around $114,013. Triggering over $200 million in liquidations of leveraged long positions. This decline has dampened sentiment in the derivatives markets, especially among traders who were betting on continued upward momentum. After 3 consecutive weeks of failing to hold above the $120,000 mark, many investors are starting to lose confidence. But does this mean the bullish trend is over? In typical market conditions, Bitcoin's monthly futures tend to trade at a premium of about 5% to 10% over the spot price, reflecting the cost of longer settlement periods. Currently, the premium has shrunk to just 6%, the lowest in 4 weeks, indicating waning demand for bullish leverage. While this isn't a clear sign of a bear market, it does suggest that traders are less confident even with institutional interest remaining high. Adding to the complexity, Bitcoin's relationship with traditional markets has shifted. Despite being only 7% below its all-time high of $123,182 from mid-July, Bitcoin is now moving more in tandem with stocks than with gold, which remains steady around $3,350. Many expected Bitcoin to act as a safe haven, like digital gold, especially as global trade tensions escalated. Instead, Bitcoin's correlation with the S&P 500 has surged above 70% over the past 3 weeks, making it behave more like a high-risk tech stock rather than a safe store of value. This change could partly explain why Bitcoin's market cap, now around $2.3 trillion, rivals giants like Amazon and Google. This shift isn't necessarily negative. Markets are dynamic, and investor perceptions evolve over time. Broader economic factors, such as U.S. import tariffs and an expanding money supply, influence all asset classes. For instance, demand for the 1-year U.S. Treasury notes has hit its highest level in 3 months, with investors accepting lower yields amid signs of a weakening job market. Recent revisions to employment data and rising unemployment rates support this cautious stance. Turning to the options market, which often reveals traders' true sentiments, we see that the cost of downside protection, put options, has increased, indicating some concern about Bitcoin's support level at $114,000. The current 5% delta skew between puts and calls is on the borderline between neutral and bearish, a notable reversal from July, when bullishness dominated. This suggests traders are increasingly wary of further declines. Investor sentiment also took a hit after nearly $115 million flowed out of spot Bitcoin ETFs on Thursday.